What's up, guys? Welcome back to the channel. So today is episode 98, and today we're going to go ahead and take a look at 5 tips for better risk management. Risk management is very important. I see a lot of people get into stocks, they get lucky, they have a couple of wins, and then they blow up their account, and you never see or hear from them again. So managing your risk is very important, and you should definitely not be gambling. All right. We don't gamble. We take a calculated risk based on historical patterns, and we know when to get in and we know when to get out. And if it goes our way, great. If it doesn't, we get out. It's that simple. So let's jump straight into the video. All right. So as you guys can see, I have the top 5 risk management tips pulled up on the board. Right now, number 1, as you can see, is protecting your capital at all costs. 2, scalp more and home run less. And then number 3 is going to be scale winners and cut your losers. Number 4, be aware of trigger events. And number 5, obviously, only trade A-plus setups. So let's go ahead and get into the first topic here, which is protecting your capital. All right, so protecting your capital entails not taking unnecessary risk and doing everything you can to preserve your trading business. Think of it as continuing education. Traders need to remain focused on learning more each day. It is important to remember that understanding the markets and their intricacies is an ongoing, lifelong process. All right, so with that in mind, let's talk about a couple of these points. So one of the best ways, and it sounds crazy, I could tell you that I use to protect my capital is simply not trading. You don't have to trade every day. You definitely don't have to trade every day. And I'll tell you this, I've had days where I've had 2, 3 good trades in a row. And instead of saying, I made my target, let me close the laptop, let me go do something else. Let me go work on my websites. Nope, I hop back into something else, and guess what happens? I end up taking an L. Now, obviously, I manage my risk, so I'm not going to wipe out all that I made for the day, but I could have avoided taking that L if I had just not traded. All right. So that's one of the most important things, is not trading. The other thing is to stay away from consolidation. So consolidation is pretty much when the stock is just moving up and down, up and down, up and down in a small area. It's not really breaking up to the upside, or it's not really breaking to the downside. It's consolidating. You never want to trade that. Not for me, at least. Some people know how to trade it. Maybe your skill level is higher than mine. Chances are, though, it's not. And that's probably why you're watching this video. So for me personally, at my skill level, I stay away from consolidation. The next thing you want to stay away from is slow days. Slow days. Some days are just slow. Nothing's going on. Nothing's really moving the market. The stocks are sitting at a particular price for an hour, 2 hours. It's not moving. You will lose money that way, because remember, whenever you buy into an option, you have something called theta, which is time decay. Especially if you're trading options that expire the same day, the longer the stock sits there, the more it loses value. So I would stay away from slow days. And then the next thing I would do is to keep my positions small. And simply what I mean by that is, I'll give you an example. Let's say you have $1,000 to trade, right? And this works, obviously, if you have a cash account. If you have a margin account, you're going to be limited to 3 trades. And if you do the fourth one, you're going to have a problem. So we're talking about a cash account. But let's say you have $1,000 in a cash account, right? If I was starting out, I would enter into positions with just $100, right? Because you enter into that position with $100, you have 9 more $100 plays that you could go into. So keep your position small, don't get greedy, and you'll be okay. And the next point is going to be scalp more and home run less. Technical analysis and fast execution are paramount for successful scalping. A strict exit strategy is crucial to manage risk in scalp trading. Scalp trading is a rigorous and active strategy focusing on achieving numerous small profits on short-term trades throughout the day. So there you have it. So pretty much in a nutshell, what you're doing is, when I say scalp more and home run less, the reason for that is when you scalp, you're looking at what, taking profits 10, 20%. Sometimes it can even go to 30. I don't care if it's still going up. I'm getting out, right? Because that's what scalping is. I'll tell you this. There's a bunch of studies that have been done, but statistically, traders who scalp more have a higher rate of success versus the traders that go for the home run. What's the home run? The home run is 300, 400, 200, 100% returns, ROI. That does not happen every day, guys. And that's not realistic. What's realistic is 10 to 20%. So using the previous example that I gave you guys, if you have $1,000, right, and you're scalping 10, 20%, let's say you go 20%, right? For every $100 that you put up, you get 20 on top of it. At the end of the day, you still have $200. You had an overall gain of 20%, providing that obviously you won every trade. And if you scalp, it's highly unlikely for you to take losses. So for me, I scalp a lot. Now the home runs, yes, occasionally there's some overwhelming good news and it comes out during the middle of the day and the stock is just running and you could catch it. But don't look for those home runs every day. The people who chase the home runs are the people who always lose, like the people who, buy options going into earnings. They're looking for a home run, and then when the news comes out and it doesn't go in the direction that they thought it was going to go, or hoping or gambling that it was going to go, they get crushed. Sometimes to the point where they get wiped out. And even if you're taking small losses like that over a period of time, it'll still wipe out your account because they add up. So trade between the lines. That's the next point here. Trade between the lines, meaning you should have defined trading lines indicating each price point, and each price point should be of some significance to you. And you want to trade in between those lines. Don't wait until it touches the line. That's not what scalping is. You want to catch it when it's leaving the bottom line or the bottom of the channel and going up to the top of the channel, and get out just before it gets to the top. It's okay. You could do it again. You could, what they call, rinse and repeat. All right. And the next thing is waiting for level breaks. You shouldn't be trading anything if it hasn't broken a level. It's that simple. All right, so scaling winners and cut losers. All right, so instead of entering and exit entire positions in one go, many traders use scalping to manage their risk. You can achieve this in two ways: scaling into positions and scaling out of positions. All right, so pretty good way to just summarize this is you would buy more if the option works, and then sell if it drops 10 to 20%. And then obviously you would take profit at different levels. So when I say buy more if the option works, let's say you see a position, it looks good, the option looks good, it's at the level that you want it to be, and you buy that option. Let's say you only buy one contract and it starts to move, right? And you see that it has a way to go before it gets close to the next level, I would buy more. That's how I do it. I would buy more. And when you buy in more, now you are multiplying your gains. And then you would use the same strategy to get out. Get out before it gets to the line. I would pretty much take profits at a certain level and then let it run, right? So you could take profits at different levels. Now, as far as if you buy that same option and it starts to decay, now some people, you could set a stop loss on options, but it is kind of sticky. I'll do another video and show you guys how to do that on Robinhood. But you could set stop losses. But with options, it's kind of tricky because sometimes the stop loss will trigger and, it sells and then the stock starts to go back up. So it's a little bit tricky. I'll do another video on that. That's something totally different. And then, like I said to you, the third and final point here is just taking profits at different levels. So, let's say you identify, let's say the stock's 100, right? And you identify 120, 125, 135. You would slowly start to scale out of your position. And what that does is it actually increases your profits versus, say, buying 10 contracts. It goes up, you sell all 10 contracts. No, I would let's say I would sell 8 to secure profit, and then I would leave 2 to run. And if you guys have been watching my videos, you'll see that I've done that. If you look at some of those scalping videos that I've done on QQQ and SPY, you'll see that's my strategy. I'll sell a portion to secure, my profits, meaning I got profits, the money that I put up, I've made money on top of it, and then I'll leave 2 more to run, right? And then those 2, I'll probably take them out at different levels too. Right. And point number 4 is be aware of trigger events. A trigger event is anything that has a direct impact on the movement of the asset being traded. These are some examples: earnings, pre and post. And that's how I like to play earnings, as you guys know. I play it leading up, and then I'll play it after the earnings, whatever direction it's going, depending on the momentum. Analyst ratings. So sometimes you'll hear, they'll say, Morgan Stanley upgraded Google to blah, blah, blah price, then we know the stock's going to go up. If they downgraded Google, we know the stock's going to go down. So pay attention to things like that. Market-wide events, inflation data, CPI, PPI, those are things that you need to pay attention to because they will directly impact how your options go, especially if you're trying to do swings. You might get into a swing today and it looks all good, but you didn't check to see that, PPI data is coming out at 8:30 in the morning before market opens. Guess what? PPI data comes out and PPI is Producers Price Index, and they say, the numbers are bad because they're complaining that the cost of blah, 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 blah. Guess what? Your options will get crushed. All right. Global events, war, pandemic, etc. That's a no-brainer. If there's a war in said region that oil is produced, then the cost of things will go up, and this will affect the overall market. Political climate, obviously. Different parties are affiliated with better stock market returns. I don't know how else to say it. I won't say which is what, but pay attention to the political climate because this can also affect, and this is a key trigger event. All right, and then finally, only trade A+ setups. An A+ setup is simply when an asset moves in the direction that meets multiple levels of your trading criteria. Watching for breakouts, waiting for retests, 2 candles minimum. So those are just some of the tips that I could give you guys right now. But pretty much in a nutshell, an A+ setup is when a trade meets more than one of your particular criteria. So you might be looking for it to break above a certain level. It breaks above that level. You get confirmation via a retest, and then you have 1 or 2 candles moving in that direction as well. Also, maybe you have news that supports this move. So those are usually A+ setups, and you want to pay attention to that. You can't just be arbitrarily trading something. That's why I'm not like a big proponent of people ask me, oh, do you have a Discord? I don't have no Discord. I used to be in a group back in the day, and I realized the negative effects of the groups. You're not learning anything from those Discords, and when they just blindly throw information out, yes, sometimes it'll hit, but these people are human too. They might make mistakes and they'll put something out, but like I said, they forget to tell you, hey, you know what, PPI or CPI is coming out the next day, or there's a FOMC meeting the next day. So I'm not really big on that. You should have your own criteria set up for your A plus setups, and I would have it written down on a wall in front of me so I could see it right where I trade. And you make sure that the trade that you're entering into hits, multiple of those. So if you have, let's say you have 5 or 6, I wouldn't trade if it doesn't hit like at least 4, 3 at bare minimum. All right. But that's it for the video today, guys. I hope you found this information useful. If you did, consider subscribing. I make new videos like this every day. Please go ahead and like this video and share it with a family member or friend. And towards the end, you will see 4 cards pop up on the screen showcasing different videos that I have made. Please go ahead and click one of those cards and watch another video to learn some more about this trading journey of mine. All right. Thanks again for watching. Y'all stay safe. Have a blessed day. Peace.